Hey, everybody, I'm Neil Henderson, and this is the Nomad Capital Self-Storage Market Overview for the second quarter of 2026. I'm here with my partner, Clint Harris. Before we get into the individual properties, we want to give you our honest read on where the market actually is. Let me start with the tension because it shapes how you should read everything else. The industry data this quarter looks like stabilization. National occupancy is back near 78%. Seasonal move-in rates are up more than 4%. And the big storage REITs posted positive revenue growth for the first time since 2024. We're not going to argue with the data, but we don't think it describes the market we're actually operating in. And we'd rather say that plainly than hand you the headline. The correction may be steadying at the top of the market. It's slow. It's uneven and down in the smaller tertiary markets and the lease-up properties where we own. We haven't seen a durable turn yet. We put a broad market recovery well out, not right around the corner. So we're running the portfolio on that assumption instead of counting on the market to lift us.
Yeah, and partners, we have a lot of information to go through today, so we're going to be reading off some of it to make sure we're giving you the accurate numbers. Here's the thing about storage. It's a local business, and even though that national average hides a pretty sharp regional split, we want to highlight on some of those details. The bright spots right now are in the Midwest and the Northeast, where there isn't much new supply and people are still moving in. The oversupplied Sunbelt metros, places in Florida and Texas, are still working off a glut from overbuilding when the residential market slowed down. And a few of the big southern hubs actually led the country in people moving out this year, surprisingly, which is the opposite of what we've all been hearing. We sit in neither of those camps. Our markets are small, tertiary, and southeastern, like Neil mentioned. And for the most part, they had room for the supply that we brought, and they're filling. But they're price sensitive, and we can't say that strongly enough. When gas or groceries jump, our markets are unfortunately among the first to put on the brakes. So that fragility is still the single best swing factor on our demand, and it's the thing that we're actually watching the hardest.
Yeah. Now, on the capital side, the sector is consolidating fast, and it's worth understanding that not all of it is healthy. Some of it is strength, the roughly $10.5 billion public storage merger with national storage affiliates is institutional money moving deeper into the secondary and tertiary markets we operate in. But a good deal of it is pressure. A lot of operators bought stabilized facility at low cap rates and financed them with adjustable rate debt. As those rates reset higher, they're getting squeezed, and some are being pushed toward a sale they never planned on. We point that out because it's a reminder of how much of the financing underneath a deal matters in a market like this one. It's a big part of why we've prioritized low-cost basis and balance sheet discipline over chasing growth.
Yeah, so if there's a constructive point in all of this, it's that this is an operator's market, and that's the part that we actually can control. The industry's own conclusion this cycle is that the returns come from the operational discipline, careful pricing, ancillary income, and keeping your tenants for longer, and not from a rising market carrying everybody, because it doesn't seem to be materializing. With housing still effectively frozen, move-ins are slow across the board. The operators holding up are the ones running lean, running well-kept stores, and hanging on to their tenants. Industry-wide, the average length of stay has stretched past 19 months. That's the work we've been heads down on all year, cleaning up the receivables, projecting our rates where the market lets us, protecting the rates when we can, grinding occupancy higher one tenant at a time. Our marketing has shifted right along with that. Trying to outspend the national chains on Google Ads is a black hole. And frankly, it's a battle that we can't win. So we've leaned into the grassroots efforts and grassroots reviews instead. Community events in the parking lots, strong local reputations, low ad spend. At some of our stores, we've taken pay-per-click from over $1,000 a month down to around $250 a month, and we'd rather earn demand cheaply and locally than rent it expensively from a search engine.
Yeah. There's one forward-looking item worth putting in front of you with a caution attached. New construction has pulled back hard, roughly a 19% decline in new supply this year, and the 2027 and 2028 pipeline is thin. That points to a tighter supply picture a couple of years out, which would eventually help well-run facilities like ours. But I'd caution you against leaning on it. That's a 2027 and beyond dynamic. It does nothing for the soft conditions we're managing through today. So we're treating it as background context, not as a plan that we're relying on. So here's where we'll leave it. We're not going to tell you the headwind is behind us because it isn't. And we don't expect it to lift on a tidy timeline. What we can tell you is that we're managing these properties for a slow, uneven market rather than a quick recovery. In a market like this one, careful operations and a low cost basis are what protect the downside. That's where our focus is, and that's where it stays until conditions genuinely change. We'll walk you through each property from here.